Why don't we go ahead and get started? As I said, we're going to be recording. So good morning, everyone. I'm Sherry Porter, Senior Vice President and General Sales Manager with Berkshire Hathaway HomeServices EWM Realty. It's great to be together, and I welcome all of our attendees today, including those who are joining us as our guests. And thank you for taking time out of your schedule. I know there's a lot going on, and for you to be with us today. I'll be hosting our time as we kick off the new year with our 2023 market update with Ron Shuffield, President and CEO of our company. Ron, as many of you know, is our go-to source with the latest in real estate, and his comments on the South Florida real estate market have been featured in the Wall Street Journal, New York Times, Forbes, CNBC, the Miami Herald, The Real Deal, and a number of other news sources. So we're very fortunate and blessed to have him with us. We'll be unpacking a lot of information. So if you don't have a notepad and pen handy, you may want to grab one real quick. We're going to be recording this and sending it back out. Some of the things Ron will be touching on is how the market fared in 2022. Will inventories start to increase? How will interest rates impact the overall market? And really, what can we expect to see in 2023? If you have any questions, go ahead and put them in the chat. I'll be monitoring that. He's going to try to keep his presentation to an hour, and then we always do Q&A at the end. So are we ready?
I'm ready.
All right, Ron, take it away.
All righty. I thank you all for being here. I know we'll have some people joining us as we get started here, but I always love this slide here. We have many variations of this slide showing the place where we live. How did South Florida become the place to be? You know, one of the things we start with, I don't know if everybody can see this. Can you see the temperature today? It's drizzle rain in New York City. It's 37 degrees as we're sitting here in almost 80-degree weather. So that has never changed in all the years that this place has been here. That obviously is still one of our greatest assets. But, you know, when I think about why we live here today, it's not just because of the weather any longer. Maybe back in the 40s and 50s and 60s, that's why people came to South Florida. But today, the reason that we're all here, you know, when you look at this slide in front of us, how did South Florida become the place to be? Well, it's because of our people. Obviously, our weather and all the other assets that we have here are big, big pluses. But when people ask me, you know, what is the greatest asset of South Florida? You know, I had this reporter with Leisure Magazine is doing a story on places where people are moving today. And so she wanted to know, why do people want to come to South Florida? Well, obviously, again, it's the people. It's the global aspect of where we live today, where we literally can feel like that we're living in many countries all at the same time. And of course, you know, the multiple languages, even within our own company, we have 22 languages spoken throughout the community with people from literally every corner of the globe. So I think that when we see this new group, and when we are watching this new group of people that are moving to South Florida now, you know, many of those folks are from places a long way from South Florida. So anyway, this is a beautiful picture of that. Again, it's the diversity of our people that really make us who we are. You know, it's that, you know, those rich relationships that we have with people from many, many different backgrounds. All right, I'm going to jump right into our numbers. You guys know how much I like this slide. This is simply an overlay of the median price of our housing and condominiums, single family and condos, a slide overlaying the median price along with the months of supply. If you're brand new to our business, this is your first few months in our business, you know, the number one metric in our business is how many months of supply that we have remaining. And of course, I don't know if you can kind of see my cursor here. I'll try to move that around in here. But as you see back here in this period, back in 2000, 2007, 2008, you know, this slide obviously is a 15-year look at what's happened by quarter. So as you look, we were at 40 months of supply at one point in 2008 during the recession for single-family homes in Miami-Dade County. I'm going to show these same slides for Miami-Dade, Broward, and Palm Beach for single-family and condos. Well, back then, this is March of 2007, so, you know, 15, or now almost 16 years ago. This was our median price for a single-family home in Dade County at that time was $373,000. Well, we ran into the recession, which was a whole different problem than we're dealing with today. I mean, today we're dealing with inflation, which is certainly something to be concerned about. But back then, it was all about the the fraud in the mortgage community and all the properties that were worth less than their mortgages. So we had a lot of foreclosures, a lot of things were happening during this period here. So all of this inventory started shooting up because people continued to put their properties on the market, but sales had fallen. And the only way that you get out of that problem is to reduce prices. So as we started reducing the prices, and you see this cursor as I'm moving down this line, all the way through 2008, we just had a free fall here of price. And then after we hit a point where the consumer felt like, okay, this is a fair price, I'm safe to get back in the water here. So we had a couple of years of sort of stable prices, and then it dropped a little bit more to $150,000 for a median price of a single family home in Miami-Dade. And then in 2011, we started seeing this march upward, up every year, higher price, higher price, higher price, back to March of 2020. So this was 13 years from March of 07 during the recession. $373,000 was the median price. And then it finally got back to where we started 13 years later. So this was a long haul, but obviously our industry helped to bring us out of that. Now we hit this shaded area here is the pandemic period. So we've kind of chosen 2 years here from the spring of 2020 to the spring of 2022 to show that this is what was happening during this period. And of course, none of us knew what was going to happen in March the 13th of 2020 when we shut everything down across the country. But then we just saw a spike, I mean, a huge spike in values. I mean, people were rushing to our market because they wanted to have more open space. They wanted to live in a climate like ours and be outside more. So now we saw these prices come up, and hopefully you can read all this on your screen. 525,000 is a median price, 540,000 is a median price, 580,000 is a median price. But now look what's happened in the last 6 months. And as these prices have begun to drop. So we're today at a median price of $539,000. So all of this little movement up here shows the anxiety in the market. I mean, bouncing around. I mean, this is no longer a straight line up. It's certainly not a straight line down. We don't expect a straight line down. We think this is going to settle probably a little bit less than this. We might drop below $500 or $500,000 as a median price. But for now, this is where we are. And of course, this is where our sellers are anxious, because the seller looks down the block and realizes that their neighbor got a higher price a year ago than they're probably going to get today. We're not seeing tremendous fall off, but we are beginning to see a reduction in some of the prices. Now, coincidentally, look down at these bars at the bottom. These vertical bars are the months of supply again. Now, I know if we were all together where we could all see each other in person and talk to each other, we would know, we would all agree that 6 to 9 months of inventory is what we would hope for. That's the optimum number of months of supply. And you go back over here and we were in 35 months, 40 months, huge inventory, unprecedented for our time in this business. And then the inventory started dropping, the months of supply, dropping. And this is a nice balance along here. And then what happened when we started selling everything that we had in inventory, the months of supply started dropping until we got to 1.5 months to 3 months of supply all of last year. And
Ron?
now here, yes.
I'm sorry. Somebody's asked, why do you use the median price in the analysis? And
well,
then,
the median price, of course, just to remind everybody what that means, is half the homes are selling for more, half are selling for less. We talk about average prices some in our market. The whole industry focuses on median price more than average price. But the reason that average price in our market is not a real good example is because we have so many very expensive homes at the high end that throw those comparisons a little bit out of whack. And so we like to look at the median. Half the people are paying more than $539,000, half are paying less than $539,000. So hopefully that helps. And then, of course, from having facts and trends, each one of us have access to that. You can research this, and you should be researching this at every price point, every neighborhood, every zip code, whatever area you're searching. You should look at that in addition to this macro map that we're looking at. If we looked at every one of these, we'd be here till next Thursday. But I think that hopefully that explains why we use the median price. But now you see the months of supply are growing again. Now we're at 5.9 months at the end of December. And now we're into the first 24 days, 25 days now of January, and we're seeing that number continue to grow. We're definitely going to get back into the 6 to 9 month range, which we're happy about that because that's a comfortable spot where we know we have enough buyers, enough sellers. You know, the buyers feel like they're getting a fair deal. The sellers don't feel, I mean, the sellers feel like both sides feel like they're getting a fair deal. Whereas before, the buyers felt like that the seller had all the leverage, which they did. But now we're certainly still in a seller's market, but much less of a seller's market than the days when we had 50 people lined up or 100 people lined up at open houses and selling for more than asking price. You know, we have actually had, you're going to see pretty soon, you know, within our company, we've actually had we're working on a sale right now, which is probably going to sell for about 10% less than the buyer paid just 9 months ago. So those decisions are being made. Sellers are now weighing their prospective buyers, and many of these buyers today are coming with contingencies that we have not dealt with for a couple of years, like contingencies on selling their home. You know, certainly contingencies on financing are still important to people, but we're going to see, because of what you see in this top right corner here, we're going to see a lot more negotiation between buyer and seller. And, you know, when you see all this, you know, kind of confusion going on that I'm circling up here in the top right of this graph, you know, this is what we're living with. And it takes a year and a half in most cases for these markets to switch. And I think that, you know, we have the experience of seeing this, you know, in the past, certainly back during the recession, we saw it, you know, last 15 years ago. This is certainly not going to be a crash of any sort. I mean, I don't even like to use that word, but we are, I think, going to see a softening of prices because we have, we're going to have more inventory coming to market, and the buyers don't have as much money to spend today because of interest rates, and we'll talk about that in a minute. Okay, now I've spent a lot of time talking about that just to acquaint you with how this graph works, but now I'm going to kind of breeze through these next ones. This next one is condominiums for Miami-Dade County. Similar, you know, that you saw with this big deep V here, you know, where the market fell in July. In the condo case, the lower prices came later than they did in single family back in 2010 and 2011. But in July of 2010, the median price, half of the condos in Miami were selling for less, half were selling for more than $100,000. And of course, then we worked our way up, worked our way up, worked our way up. And then for the first time in 13 years, now all of a sudden condo owners are seeing some really nice appreciation in their units as well. But that peaked out at 410,000 back in June. And then, as you know, the interest rates really were increased, or they were increased by the the Fed rate was increased by the Federal Reserve. And then that, of course, immediately caused our mortgage rates to increase from 3% up to 7%, which we'll see again in a minute. But now we're back down for the median price of a condominium in Miami-Dade County is $371,000. So that graph is again similar, and all these graphs you're going to see now, Broward County, also very similar, not quite as deep a cut when the market fell back in after the recession, but this 2010-11 period is when everything settled out at its lowest point. And now, we're back up, and then they had the same kind of spike, but then the same thing happening here too. So back in June of this year, the median price in Broward County for a single family home rose to $595,000. Now it's back down to $530,000. It will probably come down a little bit further. And you see the corresponding months of supply growing at the bottom. I mean, this never fails. I've followed these for a lot of years. And when we get down into these very low levels like we have seen for the last year and a half, it's inevitable that we're going to have double-digit appreciation, which obviously we've had, triple-digit appreciation. I mean, we've doubled the price of some homes during this period. And now we're back up to 4.3 months in Broward for single family. And then if you go to the next graph, which is condominiums, we're back to 4 months, but this was after living for a year and a half here with, a month and a half of inventory. You see the same, confusion going on up here, or just not confusion, but just movement, kind of up and down until the market really finds its balance again. And I think that's happening. It's happening more every day now. Okay, so Palm Beach, the next one, single family homes, all prices, very similar graph. Dade County suffered the worst during the recession. We had a 60% drop in the median price of a property in Dade County during that period. And now, of course, like Dade, Palm Beach has increased, but Palm Beach got to a median price of 665,000 last summer, and now that's down to 575,000, 4.2 months of supply. And then condos in Broward, in Palm Beach, again, months of supply there also 4.2 months. Median price had gotten up to 310,000 last summer, and now it's kind of bounced around a little bit, and we're at 300,000 at the end of December. Okay, so I know some of you may have questions on that. If you do, you can just type them into the chat, and then Sherry's going to again serve as our moderator to come back and talk about some more of these things. Inflation. We had not talked about inflation for a long time. You know, many of you, weren't even here in the 80s probably, but in 1980, that period, this was a tough inflationary period. We got up to about 14% inflation. And you kind of need to look at this graph for a second to see what all these shaded bars mean. This is a recession all the way back to 1960. The gas prices in the 70s recession. I think probably a lot of us don't remember, forgotten that we actually had such a scare with not having enough fuel that we were cutting back on electricity usage. In this 1974-5 period, we had a period that if you had a building sign on your building, you were not allowed by law to even turn it on because it was using electricity. So the country was trying to save electricity. So that was part of that inflationary period there. And then, of course, in the 80s, we hit more inflation. And, if you bought a home in 1979, 80, pretty much most of them doubled in value in the 3 to 4 years after that. And then, of course, what came after that was some very high interest rates, which we'll look at in a second as well. So we got through all that period, and then we got into the 90s. Everything kind of got under control. Inflation, the Fed would like this inflation number to stay around 2%, which is kind of over here. But we've had these minor recessions back in these periods. But then all of a sudden, we saw this spike. And of course, a lot of people have theories on why we saw this spike. And part of it was that we just pumped so much new money into the market. In the stimulus money that was given to help people that had businesses closed or couldn't work or whatever, but all that money flowing in the system. And of course, Warren Buffett, predicted all this as soon as he saw all that happening, that with that much liquidity, we're going to have inflation. And of course, that was a year and a half ago, and now here we are. But July, inflation was 8.5%. The Fed started ratcheting up the rates. And so that's brought the inflation down now at the end of December to 6.5. The goal is to get to 2%. So we probably are going to continue to have these rates increase at the Fed level, but it's encouraging that our interest rates are beginning to come back down a little bit. The rate today is 6.15%. This is the global rate across the U.S. This is the average mortgage, 30-year fixed rate mortgage rate. And these are numbers that we get from the Federal Reserve every Thursday at noon. They post these numbers, that these are the averages for the week, the applications that were taken for mortgages across the country. So you go back to 81. This is when I was talking about a second ago, the inflation that happened during that period. Well, the interest rates got to 18.39%. Not many people paid that, but people did borrow money at 18% to buy a home in 81. This only lasted for 4 or 5 months at this level. But during the 80s, there was never a point in the 80s where the interest rates got below 9.22%. Even in the 95, as you see on this next one, is 9.2%. The way we've arranged this graph, it's kind of fun because the middle is the lowest rate at 2.65, and then as you come out these concentric circles, the rates get higher and higher. So here, this circle way out here is what the rates were in 1981, and then we've arranged this in order of date. So in 95, it was 9.2. In 2000, it's 8.16. In 2008, 6.63. 4.94, 3.65, and then of course, if you got a mortgage at this 2.65 or anything under 3%, I mean, you really have a historic mortgage that I don't think we'll probably see again for a long time. And frankly, we probably operate better as a whole economic system when the rates are in that 6 to 7% range, because everybody gets something. The challenge in these last few years where the rates have been so low for us, that means that retirees and other people could not earn anything on just passbook kind of accounts or, retirement funds. So now you can get in a money market account, upwards to 4%. Just in a money market account. So you're not, playing the markets in the stock market. But I think that we're going to continue to see these rates probably in this 6% range for certainly the remainder of this year. And I'm basing this on a lot of other people's thoughts. Obviously, the people who work with us every day are all pointing to that.
Ron?
Yes.
So questions come in. So what would be your recommendation to buyers and sellers for 2023? Is for sellers, is this a time to sell or wait for a bounce back? Buyers, buy now or wait until prices continue to go down? And I know interest rate sometimes plays into some of that discussion.
Sure. Well, it's pretty much impossible to pick the very highest point or the very lowest point to buy and sell, whether it's your home or whether it's stock. I think that what I tell everybody, if you're a young buyer, just get in the game. I mean, if people are still renting and they can afford to buy, then absolutely, a 6.5 rate is certainly manageable. So if you qualify for a mortgage, and of course, our folks at Prosperity have been making a lot of mortgages. I mean, we closed, 8 mortgages just last week for people. And these, many of them are over $1 million or under $1 million. I mean, at all prices. But I think that there's never that perfect time, but we know that prices of real estate over time will continue to increase in value based on what we've seen for decades. Again, I moved here in 1975, and from my window here in my office, I'm looking out across a lot of homes in Coral Gables that are on 5,000 square foot lots, 1,500 square foot homes. I could have bought any of those homes in 1975 for $75,000. And now today we're selling those very same homes for $1 million to $1.1 million. So, there's nothing to me more gratifying than seeing a young buyer who buys a home, kind of stretches to get into the home. And then 7, 8, 10 years later, they realize they've built a lot of equity in it. And then they can use that equity then to expand up to a larger home or a different neighborhood. So everybody needs to own a home if they can. Rents, we're not going to talk a lot about here this morning, but this is probably a good time to interject some of that too. Rents have had a significant increase, because that's where a lot of people want to be today. But again, we have people that were renting before that could have afforded to buy. And now we see many of those people converting from being a renter, in many cases, buying a condo in the building that they're in some cases buying the same unit that they've been living in as a tenant. So I think that, the answer to the question is, should we wait? Waiting is always, to me, a short-term decision. Yeah, you might wait till the end of the summer and see kind of what prices are doing, what inventories are doing. But interest rates are probably not going to get back down to those levels in a long time. So I feel like that the fact that we're lower today than we've been since September. The rate was actually 7% in September. We'll see that here in a second too. But I think that hopefully that answers the question. But obviously everybody expects a realtor to say, yeah, buy. But we've just seen so many proven examples of where people that bought had something of greater value down the road than those who didn't buy. All right, next page. Okay, everybody, is talking about us. This is the news this week. This is an article that came out in Fortune magazine on January the 15th. Miami to escape the home price correction in 2023, while overheated housing markets like Austin get hammered, says Goldman Sachs. Well, how would you like to be living in Austin today, where Goldman Sachs says you're getting ready to get hammered? And of course, what a wonderful place for us to live. I mean, you look at this little map here, it's not, this is the way it actually showed up in Fortune, but it's a little bit hard to see some of those colors there. But as you see, the darker that red color, the more they are expected to shift and prices would go down. So they're saying in places like Portland and Seattle and San Francisco, the values will drop at least 10%. But then in Miami, you'll see in the article here in a second that they expect our values to be, the highest in the country. Still very, very, very small growth, but 0.8%. But I think that it'll be a time that we will recognize that Miami is getting even more recognition than we've always gotten. So this is the headline. Goldman Sachs, obviously one of the most respected financial groups in the world. And after all their researchers tallied all their information, this was the article that they wrote. And we're going to send all this to you, so you'll be able to look at this and, at your own pace later. But just to look at some of these highlighted areas, we are lowering our 2023 forecast for year-over-year depreciation in the Case-Shiller Home Price Index to minus 6.1% from 4.1% previously. This would represent an aggregate peak to trough decline of roughly 10% in U.S. home prices through the end of the year from June 22, wrote Goldman Sachs. So, that's very clear, and we now see it playing out in our MLS charts that I've just shown you. And then over on the side there, it says that said, overheated housing markets in the Southwest and Pacific Coast, such as San Jose, Austin, Phoenix, San Diego, will likely grapple with peak to trough declines of over 25%, presenting localized risk of higher delinquencies for mortgages originated in 22 or late 21, writes Goldman Sachs. So, these areas, and of course, these are the metropolitan areas around each one of these cities. So this is not just the city limits itself, it's the greater metropolitan area for each one of those. So then that next paragraph, in 2023, Goldman Sachs expects double-digit home price declines in Austin, less, 15% less, San Francisco, 14% less, San Diego, 14, on and on and on. So then you go to the next page. It talks about heading forward. Goldman Sachs thinks many northeastern, southeastern, and midwestern markets could see milder corrections, if any correction at all. In 2023, the investment bank expects home prices to barely fall in places like Chicago and New York, while its forecast has prices rising in Baltimore up 0.5%, and Miami 0.8% in 2023. So all of this is positive, so positive for us. And in fact, it's so ironic. It's 7 o'clock this morning. I get this article in an email from one of my college fraternity brothers, Louis Cosby. I sent you back the link to this. So I don't know if you're watching here today, but Louis is from Tennessee, but it has a home in Naples and has businesses on the west coast of Florida. But here's a guy that saw this article, thought of me because it's Miami. And I promise you, everybody on this call has hundreds of people that know you that are reading this article, because this is big news today across the country. Fox News and other news outlets have picked this article up and are continuing to repeat it. So you just never know, what's around the corner. But this is a very positive piece for us to be using in our marketing with our buyers in particular.
And
Okay.
Ron, Lewis is
Yes.
Lewis is on the call.
Okay, well, hey, Louis, good morning. This graph is this is another favorite. This is a graph which we talked a little bit about over the months leading up to this, but we felt now is the time to really expose this more widely. There are a lot of numbers here, so I'm going to take just a second to make sure we all understand this. January the 7th, the average rate across the country for a 30-year fixed rate mortgage was 2.65%. December the 30th of 21, it had risen to 3.11. By March, it was 4%, April 5%, September 6%, October 7%, and now we're back down to 6.15%. Now, even at $1 million buyer, today in South Florida, if you go into all of our inventory for single family homes, 1 of every 3 homes on the market is now priced over $1 million. So, this is not a market just for wealthy people. I mean, this is, for some entry level people now, even though $1 million is still a major amount to borrow. But the mortgage, the principal interest payment on a 3% mortgage is $4,216. Now, if that's all you can afford to pay, which a lot of people do qualify for, whatever they buy whatever they qualify for. So if you're qualified for a $4,216 a month payment, and that's all you can pay, and now the rate has gone up to 6 or 6.5% in this range here, you have 2 choices. You can now either pay a 42% greater mortgage payment every month, or 50% greater if it's 6.5%. So the rate, if it's 6.5%, goes from the payment goes from $4,216 to $6,321. And then then you say, well, I can't afford that payment, so I'm going to have to just keep paying $4,216. Well, you're not going to be able to borrow as much money. So your mortgage lender is going to say, well, okay, that's great. We can certainly loan you money, but it's going to be 33% less than you could have gotten a year ago. And that's pretty much that simple. So we have eroded the borrowing power of our buyers in this example by $330,000. So when we're there at an open house and somebody walks in and says, well, I'm pre-qualified and here's my pre-qualification, I can afford $4,216 a month. How much can I borrow? Well, you can now today borrow $667,000. Well, your neighbor who's bragging down the street that they sold for $1 million, a year ago, the reason that they were able to do that is because their buyer borrowed money at 3%. Now, again, hopefully that's simple to look at this. You can read all this down at the bottom, that's the whole picture, the whole story is up here above, but we want to be clear with everyone that's reading this of what, how this is designed. But this graph is very important to talk to our sellers about, because the sellers are going to say, well, I'm not borrowing money, I'm not concerned with that. Well, they are borrowing money because their borrower in most cases needs to borrow money. Now, in our marketplace, about 45% of our deals are still cash, which is one of the highest, maybe the highest in the country. So I hear that a lot. Well, my buyers are paying cash. Well, that's true, but many of our buyers are also dealing with interest rates on their businesses or other places. And so everybody's affected by these headlines. So, but 55% of our buyers need a mortgage. So I think that this is a graph that our sellers need to really pay close attention to, because their buyer, our buyer that we work with, does not have $1 million anymore to spend just because the rate has changed. So now they have somewhere in that $700,000 range. And again, hopefully everybody understands that. We're going to send this out, just one little graph, so it's very easy for you to email along to other people. But this is a powerful graph to show what the impact has been from raising our rates to 3% up into the 6% range, 50% greater monthly payment, or a 33% reduction in how much you can borrow.
Ron?
Yes.
There was since you talked about the Goldman Sachs article, and when they made these projections, the comment was they also laid off over 6% of their workforce, with their Miami office included. Do you expect the large layoffs and the slowdown in hiring in finance and fintech to have a big impact on our housing market? It would seem those workers would be more hesitant to move to Miami to take a new job, considering this trend in late 2022 and what we're seeing in early 2023. So
that's a great question. And yes, Goldman Sachs, like, all the other banks, are doing the same thing. I think everybody is just trying to be careful that they're not overextended, as most people don't, none of us really know how long this is going to last. But the fact that we've seen the interest rates dropping somewhat, we still see, strong demand. If our prices were just a little bit lower, we would be having a lot more sales. I'll talk about this a little bit more, but if you look at our pending sales, the pending sales for January of 23 will be the highest, will be the first increase in pending sales in about 10 months. So if you look at the last 10 months, we've had fewer pending sales, fewer pending sales, fewer pending sales. Well, January of 23, we're going to see more pending sales than we had in December. And typically we don't see that. Typically it's the other way around. So I'm encouraged that we have a lot of buyers out looking today. I mean, many of you have told me that your open houses and your showings are up, from 0 to 5, 10 people, and we're making deals. And I think that's going to be the real test here as we wrap up January, to see how many pending deals we made. And I think we're all going to be pleased to see that in all 3 counties right now, through the 23rd, where I looked yesterday, through the 23rd of January. So January 1st, January 23rd, compared to the same first 23 days of December, we have had more sales in January by about 10%. So that's a good thing, but it'll take a while, to start seeing the closings, because as you know, when we sell a property, it takes us, 35 or 30 to 45 days to close that at the fastest. And we will have to wait to see, that all those close. But I just, so much of this business, you just feel it. And, anecdotally, we are seeing a lot more activity, and people are willing to negotiate again. We unfortunately had some sellers, during these last 6 months that just said, well, no, I'm not lowering my price, forget it. And now many of those sellers have come to the party and are now reducing their prices, which are still giving them huge gains on what they have invested in their properties. But I think that this is not uncommon. We've seen this with all these cycles, and it usually takes a good 18 months for the seller to kind of say, okay, this is the new normal and this is what we're going to do. So anyway, I guess, Sherry, was there any other comment?
Yeah, actually there was, wanting your thoughts on why Tampa is projected to drop 11%, yet Miami is up 0.8%, when both markets in many ways are very much the same.
Well, I think that kind of goes back to the other question. Miami is just on fire right now. You know, Citadel, if you didn't know about Citadel before, this is going to affect all of our Tri-County area. You know, Ken Griffin has decided he is moving his company from Chicago, 1,000 people. And many of these people are buying in our communities, not small homes, but, you know, $3, $4, $5 million homes. And that's obviously a very successful hedge fund, financial group that has done extremely well, and they see their future in South Florida. Tampa is also another great market. I'm not sure why that market is being kind of pointed to by Goldman to say that they might have a further drop, but frankly, the entire state is doing well, and we'll talk about that here in a second too. But Florida in general now is growing at the rate of 1,142 people a day. These stats just came out from the U.S. Census about a month ago. So last July, they peg it for the prior July. So July of 2022, they showed South Florida they showed all of Florida as being the fastest growing state in the nation. We grew last year by 1.9%, which equates to 1,142 people a day. Texas is right there with us, a little bit less percentage, but a few more people because they're a larger state. They're growing at over 1,200 people a day, but we'll see those numbers here in a second too. But yes, jobs are being eliminated by a lot of tech companies, but we only need a tiny percentage of that industry to show up here to have a huge impact. And we have a lot of those people coming here. And it's not just those people, it's foreign companies. We're very involved in the Miami-Dade Beacon Council Economic Development Agency. And this has been the most robust year we've ever had with new companies coming. And we're seeing the median income that these new companies are paying double what our median income was as a county before. So a lot of those things are still coming to fruition. But we have a whole new mindset about where people can live today. And when you look at being able to live in a place where you have air transportation anywhere in the world in a matter of hours, you certainly have the weather. I cannot underestimate the value of our diversity. People want to live here because they want to experience the diversity that we enjoy here. So we're building a lot of housing, at least in high-rise buildings. Single family homes are becoming more collector's items now because we just can't build anymore. We have to tear our house down to build one in most of any of these three counties. So, okay, I can talk all morning about that, but
great. And that kind of brought us up to speed. And I know people want to hear about the condo and luxury. So,
yeah. Okay, awesome. So this is a map of obviously the U.S. and it talks about the maximum tax that people pay in all these states. Now, there's a lot of detail which we can get into if you have somebody moving from one of these states or if you want to target people in one of these states. But those 8 states that are colored in green are the only 8 states in the nation now that do not have a state income tax. So if you live in Washington, Nevada, Texas, Tennessee, Florida, all those states have no taxes. And, they all maybe have something, some will say, well, the real estate taxes are more here, some, maybe you pay on some of your equity holdings, your stock funds and other things. But generally, these are the numbers that everybody measures each other by. So you look at New York over there at 10.9%. Now, that's for people that make a lot of money. But even if you go to the tier below that, which would pick up a lot of just what we would consider, everyday people, they're still at 8.5%. Plus, if you live in the city, you're paying another 3%. So if you're living in New York City and making a lot of money, you're paying over 13%. If you're living in California over there on the left coast, you see that 13%. Oregon 9.9%. So all those darker shaded states are very high taxes. And then even the middle ones. I mean, who wants to pay another 5 or 6% of their income in tax? Now, I think that this will continue to propel us. Florida and Texas and Nevada have been the three states that have benefited the most because Nevada is right there next to California. So a lot of Californians now have moved over to Nevada or to Texas. And of course, Florida's now pulling from everywhere. I mean, New York was initially where a lot of folks were coming from. And now we have an equal number of people coming from Illinois or Chicago area and, California, of course. And, it was a big surprise to me to see so many Californians moving here. And of course, we can kind of judge a lot of this by just looking at the license plates that are on our streets. But, this is another huge reason why we will continue to see companies moving here, even the companies that have had to start laying people off during this term that we're in now. All right, then this one is the population I was talking about a second ago. And this is fun too, because these colors, you don't even really have to look at the states just to see that the Northeast is draining into the South. And, when you think about all those states that are colored blue, lost population last year, that's a lot. That's 18 states in the nation lost population. And then the states that led the growth, obviously you see Texas there, 1,290 people a day, Florida, 1,142 people a day. And in North Carolina, Georgia, a lot of those states that are gaining a lot. North Carolina is gaining 365 people a day, Georgia, 342 people a day, South Carolina. All those southern states are picking up a lot of that that's coming out of the Northeast and across the country. I think that we will continue to see this kind of relocating of a lot of people because people can work where they want to work today. I mean, we have a lot of people that are working in Miami and maybe live in the mountains, and vice versa. People that are working here are working there and wanting to live here. So I think we will continue to see a further growth of our population because we've seen this growth for decades now, but nothing quite like we're seeing today. But these are great graphs to show people because I don't think people realize, how many of these other states are moving into these areas. The South in general, though, and it's not on this graph, but the South in general is the one that's really picking up most of the growth. The Northeast is a whole community in the Northeast. Lost 218,000 people last year. The Midwest lost 50,000 people. The Western U.S., that's Colorado and a lot of those states that are still gaining. They gained 153,000, but the South gained 1,370,000 people. So the South had that many newcomers to their community. Okay, exchange rates. I grew up in Tennessee. I never thought about exchange rates, but all the years I lived in Florida, it's been fun to kind of watch this. It's not always fun for some of these countries, but we keep track of this, so we see what our friends from the South, especially, and from Europe and all over the world, how their money or what value their money has. Argentina is the one which has been really tough to watch. If you go back to 2007. Argentine currency, the peso there is only worth about 2% of what it was worth in 2007. And of course, again, just this 1 year, it's continued to decline in value against the dollar. So it's 72% more for an Argentine to exchange their currency. Most of the people that we work with from places like Argentina or Colombia or anywhere in South America, they already have moved money here. But these are just good numbers to watch. And of course, the dollar is just so strong, has been so strong all across the globe for a long, long time. Okay, the overall market. Okay, here we go. We're going to kind of quickly go through these. This is Miami-Dade County, Broward, Palm Beach, the way we've arranged all these slides. So this page is like everything that's on the market. So we have seen in the last year, this is from December of 22 or December of 21 to December 22. A year ago, we had 2,417 single-family homes. That's all we had for sale. Now, this December, we had 4,108, so we had a 70% increase in inventory. The total sales decreased 37%. So a year ago, for the fourth quarter of 21, we had 3,848 sales. This is, of course, not just our company. This is the entire MLS and for Miami-Dade County. And this year we had 2,428, so we had a 37% drop in the number of units sold. Now, you don't want those graphs going in opposite directions. That's not a good thing. So we want those to get closer back to each other. but we still need more inventory. And now the supply, that's a good sign too, because we want to have 6 to 9 months of supply. And right now we have 5.2 months of supply, but a year ago, fourth quarter, we had 2.1 months of supply. Median price is up 11% from 503 to 558 at the end of the year. But as we've seen on that prior slide, we're already down in January to 539,000. So that median price is not going to have a green arrow this next report, probably next quarter. It'll probably be a red arrow. And Broward County, similar relationships, but the numbers are a little stronger. 130% increase in inventory. Sales are down 36%. Supply is up to 3.8 months. But Broward County probably fared better, or had less volatility during these past years than a lot of markets. But they only had 1.2 months of supply, and now they have 3.8 months. Again, we need 6 to 9 months for a balanced market. Palm Beach is really it's just gotten more and more expensive. It's a fabulous place up there as well. Their median price is up now to 595,000. Actually, it was over 600 now. 141% increase in inventory, 35% decrease in number of sales. Supply, 250%. When you're working with small numbers from 1.2 months to 4.2 months, the percentages get a little wonky looking to be that high, but that's what it is. So those are single family homes, all single family homes in the 3 counties. And then this compares to condominiums for all 3 counties. Inventory is up, Miami-Dade inventory for single family or for condos up 8%. Total sales are down 44%. Months of supply are up to 5.9. Median price is up 12. That's all very similar to what we saw in the single family market. Broward County inventory up again, sales down. Supply still at 3.4 months. Median price there, we've already looked at those graphs. Inventory for Palm Beach up 118%. The number of sales are down 39%. Supply is up 227% for 3.6 months. Again, that bottom row there with all those months of supply, way low. We still need 6 to 9 months. As long as we keep at that level, prices are going to stay pretty strong. I think that the lower prices are probably not coming down at all. They're probably still going up. When you get into the mid prices and the very high prices, we have seen that those adjustments coming down in some price. Okay, under $1 million market, this really is getting so thin for our market. We a year ago had 1,594 on the market. Today we have 2,419. Sales are down to 2,000 sales. If we had more quality inventory at this price range, we would be selling more, and the same for all 3 counties. But again, I would point, when we finish here today, if you just remember the months of supply are still very low. We need more months of supply. If we get more inventory, we will make more sales. So, our sellers, hopefully will hear that message, but that they cannot just double the price of their property. Okay, this is the over $1 million market. So this is where I was saying earlier, this represents about 1 of every 3 properties on the market for single family and about 1 of every 5 for condos. So we certainly have become a $1 million place. I know there's a house in Gables Estates that's on the market today for $45 million. We sold that house in 1984. And that was one of the first sales I was involved in when I got to EWM. In 1984, we sold this house for $1.5 million in 1984, and now it's on the market today for $45 million. So that gives you an idea of what's happening in that particular neighborhood and in that particular price range. Okay, so Miami-Dade County, over $1 million market. Once you get in the over $1 million market, we can handle 12 to 18 months of supply and still do fine. I mean, that's kind of what we're looking for, 12 to 18 months of supply in the over $1 million market. Well, in the over $1 million single family market, we're at 12 months of supply. So we're definitely getting back into a more balanced market. This is going to be a more balanced market for buyers. So it gives buyers some encouragement that it's not just going to be, 10 offers on every listing. The sellers hopefully will look at this percentage or look at this number of months of supply reaching 12 months from 4 months just a year ago, and realize that, our pricing is important again, that we can't just, add, multiple factors to our asking prices and hope to get it. So these are single family homes over $1 million. These are condominiums over $1 million. It's amazing. For a decade now, we've been selling more $1 million condos than we have $1 million single family homes. So here in Miami-Dade County, we sold 688 sales a year ago, 421 today, over $1 million. And condos, I guess they're about the same right now, but generally condos have been over $1 million, have been outselling the single family homes over $1 million just because we have more of those now. Okay, now market data by price segment. So I'll kind of breeze through these two. So these are the under $500,000 market, which is virtually gone today. We still have 716 of these on the market, but they're obviously in very small units. A lot of them need updating, but in the single family market, we just don't have very many homes under 500,000 anymore. And then in the condominiums under 500,000, this is a robust market right now. We're seeing a lot of activity in this market. Still only have 2.8 months. I mean, this was a market just a couple of 3 years ago that it was not uncommon to have 2 years of supply of this market. And now we have 2.8 months under 500,000. In Broward County, similar 3.6 months. In Palm Beach County, 3 months of supply. And again, I keep talking about the months of supply, but that's the most critical measurement here. If you tell us what the months of supply, how many months of supply you have, we don't even need to know the city you're talking about to tell you whether prices are going up or down, because that's what drives price value. Okay, 500,000 to $1 million. Again, increase in inventory. Sales are not down quite as much. Months of supply at 4.9 months. Again, you're going to have all these reports to look at later, but this is a condominium report. 8 months of supply there for Miami, 7 months for Broward, 5.4 months for Palm Beach. This is the $1 million to $2 million market. Another good solid piece of the market. This is where a lot of our buyers land today at this price range and the next one. 8 months of supply in Dade County, 5.5 months in Broward, 5.8 in Palm Beach. And now this is the condominium market. And again, 12.8 months. This is still in a very favorable range for Dade, 9.1 months, still low for Broward, 7 months in Palm Beach. And then the 2 to 3 million, again, this is another real sweet spot in the market. This is where a lot of our buyers are looking today. And we only have 291 single family homes for sale. This price range in Miami-Dade, Broward, 190, and in Palm Beach, 268. But now our months of supply are getting up there, 18 months in Miami-Dade, 12 months in Broward, and only 7 months in Palm Beach. And then this is the condominium market in that price range. Again, 13.6 months in Dade, 17 months in Broward. And now this is the $3 to $5 million range, single family. Again, these are similar size ranges to the 2 to 3, and now with 3 to 5, about the same number of properties on the market, 280 in Miami-Dade, but now we're at 20 months of supply versus 5 months a year ago. So this is where price starts to make a difference. So if we've had if we thought we could get what our neighbors got in January last year, then we probably need to take a closer look if we're in this price range. And we are getting some good reductions in this price range, and the sales are happening. Okay, this is condominiums in that price range, 22 months of supply. So now we kind of moved out of that safe range of 12 to 18 months. So I think we definitely in this price range will start to see a little bit better negotiating just because of the months of supply. 17 months in Broward, 15 months in Palm Beach. 5 million to 10 million, 25 months of supply. Again, this is 185 homes on the market at 180 a year ago. So we're gaining more inventory. Sales were down considerably in this price range. So I think that, a lot of the people that are buying in this price range have a lot of other assets. And so they probably are looking at, 10% drops in their net worth with everything else that they own. So it makes people stop to think, okay, do I need a third home now in Miami today? They don't give up on it, but they might have delayed it for a little while. So I think looking at some of these graphs will help our sellers to understand that buyer is out there, but this is what our buyer is looking at as well. In Broward County, 56 months of supply in this price range. Palm Beach, 29 months of supply. Okay, this is condominiums, similar picture. We have a lot of $5 to $10 million condos now, 245 on the market in Dade, only 17 in Broward, 47 in Palm Beach. But, the condominium lifestyle in Miami-Dade, well, all of the three counties. I mean, each one of these buildings is now like a little mini country club. I mean, the amenity packages that we have, it's just it's a wonderful lifestyle that many people are now adopting as a full-time lifestyle. We're seeing people that were in larger homes that want to downsize, but going from a 10,000 square foot house to a 7,500 square foot condo. But we don't have a lot of 7,500 square foot condos, so we're seeing some buildings where we're seeing multiple units being added together. Most of our luxury buildings in the Brickell area and on the beach, you'll find many of those that have had units combined and even 3 units combined. All right, so this is $10 million and over, 47 units on the market, 32 months of supply, Broward 41 months of supply, Palm Beach 29 months of supply, and $10 million and higher. So actually have fewer on the market, 91 on the market versus 100 a year ago. But as you see, that's the first inventory drop I think I've seen. So, hopefully we'll continue to see this inventory growing in most of these markets, but it's going to be hard because the demand is very, very strong at all these price ranges. And, we're just getting into our best selling season. I mean, this period we're in right now is all the way through spring, is going to be a really good time for us, even with interest rates being higher, as long as we can continue to see positive movement in the inflation rate. Okay, so, gosh, I guess that's it.
Wow, Ron, you did really, really well. It's 11 o'clock. I do
Okay.
have a couple of questions. One that came up was talking about how do you account for inventory comparisons to make sure you consider new building completion? And just kind of wondering within each building, is inventory going up, down, or staying the same? They had an example of a building where they have a sale that it's the only 3-bedroom. And so just kind of wanting to get your thoughts into that as we look at these, having the inventory conversation.
Well, that's a great question too, because we have thousands of units under construction now. Many of these new buildings, as you know, start at $2 million and higher. We have the Waldorf Astoria downtown Miami. It's a 100-story building. It's our first 100-story building, which is still kind of hard to imagine, but it's a beautiful building, and our company has sold a lot of those units there. And I think that many of those people are probably second home buyers still, but that inventory will be coming to market at some point. And if everything holds, the way we've seen that all these other buildings, when they come on the market, we usually get a nice dose of those back on the resale market. And, there's a little trite saying that says in New York, you trade stock, in Chicago, you trade options, and in Miami, we trade condos. And some days I think that's the truth, because we have a lot of those buildings will come back on the market. So you have to kind of look out 2 years, even 3 years, and try to gauge that. So if I'm a seller today, you certainly have less competition today than you're going to have when some of these new buildings are finished. Now, you'll always have a price differential because these new buildings are selling upwards to $2,000, $3,000, even more per square foot, whereas we still have many wonderful opportunities under $1,000 a square foot in many of these buildings throughout all 3 counties. So I think that's probably what that question is asking. How do you gauge that? How do you plan for that? And all I know is that the inventory is coming, because we watch it every day being built. And we're thankful for that, because that's all more inventory for our industry to sell. But at the same time, it will affect these supply numbers as we have a lot more supply, and it will draw more buyers, but probably not enough new buyers to keep a lid on the supply.
Let me also ask about, because somebody brought that up in the chat, what to expect in the condo market due to the new SB4D bill, like the 30-year certification, the reserve study, all of that. How do you see that?
I think we're seeing that now. Most all the condominiums that I've closely involved with have had some, in some cases, significant increases in their homeowners fees this year. And of course, many buildings are dealing with assessments now for major repairs or major renovations, whether it's chillers or air conditioners on the roof or elevators or all those things in buildings. So, it's just the cost of living. I mean, I think one of the fallacies that homeowners have had through the years is, though I can live in my single family home for less. Well, if you're maintaining your single family home, it's probably not less than, you still have to have a roof every 25 years or whatever, and you have to take care of your landscaping, and you have to take care of your plumbing and all those things that in many cases, that's a condominium setting aside reserves for that. So when we look at some of these condo fees, which are approaching in many buildings now $1 a square foot per month, it does seem like a lot. But then when you do the comparison of what it costs to, to take care of your own single family home, that sort of plays out. So I think that, insurance is probably a topic that, hasn't come up yet, but it's something that we certainly are keeping our eye on. I know that our legislators are talking about that seriously too, because, we have to have insurance, and some of, every time we have a storm, we have a lot of people in the insurance business. And of course, today it's not inexpensive. And so, between taxes and homeowners fees and insurance, I mean, you've got some sizable costs there, but we're all going to have more costs, of home ownership. But then the reward is, when you sell these properties, in most cases, I mean, we've seen significant growth. I mean, these homes where we sold for $1.5 million 40 years ago, and now we're selling them for 20 times that or more.
One of the questions that somebody asked, and it's more out of a lens of being a newer to real estate, what do you do, or what are some of the best ways for someone to keep up with what's going on in the market? Do you have any thoughts or suggestions on that?
Well, I think to talk to each other. I mean, I learn everything from all of you. I won't call any names here, but some of you were very kind to give me some updates on things that you're working with, where, we have, I mentioned that earlier, where we have a buyer who had a change in their situation, and they needed to sell their home after buying it just 9 months ago, and they're selling it for 10% less. Well, and then we have still a very active market, but that's just kind of what the buyers are seeing happen to values today. Well, I learned that from you. I mean, all of our associates. I mean, I don't think it's any better team anywhere in the world than what we have on this call here, because you guys are 100% committed. You're out in the market every day. You're having these conversations with buyers and sellers, and pricing is more of an art than a science. I mean, our selling our community has a lot to do with that. That Goldman Sachs article that I showed a minute ago. I mean, there's no way to put a value on what that means for our market today. I mean, it's talking about Miami, but Miami is the brand. South Florida and all of Florida is the product. And, whether you're coming from Europe or South America or New York or California or wherever, I mean, I don't think South Florida and Florida in general has ever had this type of recognition. I mean, it's always been a great fun place to vacation and all that, but now we're building a corporate base with high-powered people. I mean, I grew up, there wasn't a $500,000 house in the town I grew up in Tennessee. I mean, we certainly have more expensive homes every day, but, I never met a billionaire before I moved here. And I mean, I know more billionaires, I mean, we all do, than I can remember. And Forbes says there are only 2,250 billionaires in the world. And to kind of put that in perspective, the Porsche Tower on Miami Beach claims that they have 22 billionaires. They claim that they have 1% of the world's, they have 22 billionaires living in their building, which is theoretically 1% of the billionaires in the world. So in one building, and in Miami. And of course, in Palm Beach, you could certainly multiply that again and again. And I think that, we're going to be a much more expensive place to live. We are already a more expensive place to live. I don't know how bold I want to be about saying where that's leading in 20 years, but, I never thought that we'd be compared to London and Paris and, and all those types of world cities that are thousands of years old. Monaco will probably always be the most expensive city on earth. I mean, they're like 10 times our median price here. But Miami is certainly going to be, and South Florida in general is certainly going to be in that top tier of, a handful, 4 or 5 cities that'll be some of the most expensive in the world. And of course, that scares people who are still trying to work and earn a living, because we just have a lot of people coming here with a lot of wealth. But at the same time, it gives all of the rest of us an opportunity, to benefit from that wealth that's here, whether you're selling homes or whether you're selling cars or whether you're a restaurant owner. I mean, the amount of money that's flowing already through these markets is great. And it's not just here, it's, the west coast of Florida, it's everywhere. But I think that we probably will, we'll continue to have these peaks and valleys, and I don't even like to use the word valley, because I think that these adjustments will be much softer than some we've seen, certainly softer than the recession was.
I didn't really have any other questions in the chat, but I know this was a lot of great information, and I know it takes a lot of time to put it all together. And we did record this today, which we'll also send out, as well as your presentation slides. So I don't know, as we wrap up our time together, if you had any other final thoughts you wanted to share with everyone.
Well, I think the takeaway to me is looking at these months of supply. The months of supply are growing, which is a good thing. We're still below where we would like to be. We'd like to be in that 6 to 9 months of supply, and we're still below that in most of these markets. In the over $1 million market, at 12 to 18 months is kind of what we're targeting. But I think that we just have so much yet to look forward to. I mean, these companies that are moving here, providing new jobs. Our average hourly wage is up a lot. I mean, I think many of our companies here now are paying a minimum of, $15 to $25 an hour for just entry level workers. And, people need that and more, just to live. And I saw where, I think it was Walmart this morning, said that their minimum wage now is going to be $14 an hour. So, this is what inflation is doing, but it's the right thing to do to bring these people up to, a higher level. So I think that we have, when you say, when you say, where is the market? I mean, the market is, we're on everybody's list. I mean, everybody is talking about Miami and South Florida in general, and they're here looking today. Those sales that we're talking about pendings, which we're watching the first 23 days of the month. This will be the first month in 10 months that we've sold more than the month before. And I think that's how you start working back out of these situations. The fact that our interest rates are hopefully going to stay balanced in the 6% range. Prosperity Home Mortgage, which obviously helps many of you with your customers. If you do not have a buyer's advantage, approval, they can give us, your buyer, an approval that is an approval of everything, I mean, your credit and everything except for the house and the appraisal on the house. So if you can already have that in hand, that's going to be much stronger. That's going to give you a much stronger position in your offers that you're presenting for those buyers to say, look, we have a mortgage already. We just need to get your house closed, and then we'll close quickly. So if you haven't already begun that with every serious buyer you have, then I would do that sooner than later. We are fortunate to have the Berkshire Hathaway brand. Everybody loves Warren Buffett. Warren Buffett, he calls all these markets, back at their annual meeting in May. He and Charlie Munger, who is his number 2, vice chairman of the board. Charlie Munger just turned 99 years old on January the 1st. These two guys are as sharp as anybody you would want to talk to. And they were talking about cryptocurrency, and Warren says, well, I look at it like you got to compare it to other things you can do with your money. So I'd rather own a piece of land where I can grow food, or own an apartment building where I can rent apartments. He says, if I have crypto, he just put me in a room with 1,000 other people and we sell to each other. And so those were his words, out of their meeting. And so, again, crypto is here to stay, and I'm not saying that we should not have crypto, but I think that that's just another indication of the leadership that we have all up and down the line, through our Berkshire Hathaway, HomeServices of America, brand. And, we're the largest company in America selling more properties than anyone. This year was fewer sales, but, last year we had, we sold 1,000 homes a day on the average. And so we just have a lot of hardworking people, just like all of us here, that are carrying our brand and carrying our name, throughout those markets. So, we never have a problem when we work with buyers or sellers, never have a problem with them appreciating who we are. And so having that name to open so many doors for us has been so helpful, and it will continue to be. And I think the knowledge, that we carry goes a long way. I mean, the media comes to us looking for numbers. Others in our profession come to us looking for the numbers because you guys have done such a great job of helping us keep those numbers. So, Sherry, that's pretty much it. I appreciate what everybody does. I know it's not easy. I mean, I'm out there every day with you too, and I'm always happy to talk to sellers who want to have somebody give them another perspective, and buyers. But we have a lot of people working very hard, and I don't want you I want you to know for sure that we recognize that from my office and through all of our management team here, that there are days that are very long, but also very rewarding, and we have a lot to look forward to working together.